E. An owner-based approach to corporate charity. A recent survey reported that about 50% of major American companies match charitable contributions made by directors, sometimes by a factor of 3 to 1. In effect, these representatives of the owners direct funds to their favorite charities and never consult the owners as to their charitable preferences. I wonder how they would feel if the process were reversed and shareholders could invade the directors' pockets for charities favored by the shareholders. When A takes money from B to give to C, and A is a legislator, the process is called taxation. But when A is an officer or director of a corporation, it's called philanthropy. We continue to believe that contributions, aside from those with quite clear direct benefits to the company, should reflect the charitable preferences of owners rather than those of officers and directors. On September 30th, 1981, Berkshire received a tax ruling from the U.S. Treasury Department that, in most years, should produce a significant benefit for charities of your choice. Each Berkshire shareholder, on a basis proportional to the number of shares of Berkshire that he owns, will be able to designate recipients of charitable contributions by our company. You'll name the charity, Berkshire will write the check. The ruling states that there will be no personal tax consequences to our shareholders for making such designations. Thus, our owners now can exercise a perquisite that, although routinely exercised by the owners in closely held businesses, is almost exclusively exercised by the managers in more widely held businesses. In a widely held corporation, the executives ordinarily arrange all charitable donations, with no input at all from shareholders, in 2 main categories. 1. Donations considered to benefit the corporation directly in an amount roughly commensurate with the cost of the donation. And 2. Donations considered to benefit the corporation indirectly through hard-to-measure, long-delayed feedback effects of various kinds. I and other Berkshire executives have arranged in the past, as we will arrange in the future, all charitable donations in the first category. However, the aggregate level of giving in such category has been quite low, and very likely will remain quite low, because not many gifts can be shown to produce roughly commensurate direct benefits to Berkshire. In the second category, Berkshire's charitable gifts have been virtually nil, because I am not comfortable with ordinary corporate practice and had no better practice to substitute. What bothers me about ordinary corporate practice is the way gifts tend to be made based more on who does the asking and how corporate peers are responding than on an objective evaluation of the donee's activities. Conventionality often overpowers rationality. A common result is the use of stockholders' money to implement the charitable inclinations of the corporate manager, who usually is heavily influenced by specific social pressures on him. Frequently, there is an added incongruity. Many corporate managers deplore governmental allocation of the taxpayer's dollar, but embrace enthusiastically their own allocation of the shareholder's dollar. For Berkshire, a different model seems appropriate. Just as I wouldn't want you to implement your personal judgments by writing checks on my bank account for charities of your choice, I feel it inappropriate to write checks on your corporate bank account for charities of my choice. Your charitable preferences are as good as mine, and for both you and me, funds available to foster charitable interests in a tax-deductible manner reside largely at the corporate level, rather than in our own hands. Under such circumstances, I believe Berkshire should imitate more closely held companies, not larger public companies. If you and I each own 50% of a corporation, our charitable decision-making would be simple. Charities very directly related to the operations of the business would have first claim on our available charitable funds. Any balance available after the operation-related contributions would be divided among various charitable interests of the two of us, on a basis roughly proportional to our ownership interest. If the manager of our company had some suggestions, we would listen carefully, but the final decision would be ours. Despite our corporate form, in this aspect of the business, we probably would behave as if we were a partnership. Wherever feasible, I believe in maintaining such a partnership frame of mind, even though we operate through a large, fairly widely held corporation. Our Treasury ruling will allow such partnership-like behavior in this area. I am pleased that Berkshire donations can be owner-directed. It is ironic, but understandable, that a large and growing number of major corporations have charitable policy pursuants to which they will match gifts made by their employees, and, as noted above, many even match gifts made by directors, but none, to my knowledge, has a plan matching charitable gifts by owners. I say understandable Because much of the stock of many large corporations is owned on a revolving door basis by institutions that have short-term investment horizons and that lack long-term owner perspective. Our own shareholders are a different breed. At the end of each year, more than 98% of our shares are owned by people who were shareholders at the beginning of the year. This long-term commitment to the business reflects an owner mentality which, as your manager, I intend to acknowledge in all feasible ways. The designated contributions policy is an example of that intent. Our new program enabling shareholders to designate the recipients of corporate charitable contributions was greeted with extraordinary enthusiasm. Of 932,206 shares eligible for participation, shares where the name of the actual owner appeared on our stockholder record, 95.6% responded. Even excluding Buffett-related shares, the response topped 90%. In addition, more than 3% of our shareholders voluntarily wrote letters or notes, all but one approving of the program. Both the level of participation and of commentary surpass any shareholder response we have witnessed, even when such response has been intensively solicited by corporate staff and highly paid professional proxy organizations. In contrast, your extraordinary level of response occurred without even the nudge of a company-provided return envelope. This self-propelled behavior speaks well for the program and speaks well for our shareholders. Apparently, the owners of our corporation like both possessing and exercising the ability to determine where gifts of their funds shall be made. The Fathers Knows Best School of Corporate Governance will be surprised to find that none of our shareholders sent in a designation sheet with instructions that the officers of Berkshire, in their superior wisdom of course, make the decision on charitable funds applicable to his shares. Nor did anyone suggest that his share of our charitable funds be used to match contributions made by our corporate directors to charities of the director's choice, a popular, proliferating, and non-publicized policy at many large corporations. All told, $1,783,655 of shareholder-designated contributions were distributed to about 675 charities. In addition, Berkshire and subsidiaries continue to make certain contributions pursuant to local-level decisions made by our operating managers. There will be some years, perhaps 2 or 3 out of 10, when contributions by Berkshire will produce substandard tax deductions, or none at all. In those years, we will not affect our shareholder-designated charitable program. In all other years, we expect to inform you about November 10th of the amount per share that you may designate. A reply form will accompany the notice, and you will be given about 3 weeks to respond with your designation. The designated contributions idea, along with many other ideas that have turned out well for us, was conceived by Charlie Bunger, Vice Chairman of Berkshire. Irrespective of titles, Charlie and I work as partners in managing all controlled companies. To almost a sinful degree, we enjoy our work as managing partners, and we enjoy having you as our financial partners. In addition to the shareholder-designated contributions that Berkshire distributes, managers of our operating businesses make contributions, including merchandise, averaging between $1.5 million and $2.5 million annually. These contributions support local charities, such as the United Way, and produce roughly commensurate benefits for our businesses. However, neither our operating managers nor officers of the parent company use Berkshire funds to make contributions to broad national programs or charitable activities of special personal interest to them, except to the extent they do so as shareholders. If your employees, including your CEO, wish to give to their alma maters or other institutions to which they feel a personal attachment, we believe they should use their own money, not yours. Let me add that our program is easy to administer. Last fall, for 2 months, we borrowed one person from National Indemnity to help us implement the instructions that came from our 7,500 registered shareholders. I'd guess that the average corporate program in which employee gifts are matched incur far greater administrative costs. Indeed, our entire corporate overhead is less than half the size of our charitable contributions. Charlie, however, insists that I tell you that $1.4 million of our $4.9 million overhead is attributable to our corporate jet, the Indefensible. Below is a list showing the largest categories to which our shareholders have steered their contributions. A. 347 churches and synagogues received 569 gifts. B. 238 colleges and universities received 670 gifts. C. 244 K-12 schools, about 2/3 secular, 1/3 religious, received 525 gifts. E. 180 religious social service organizations, split about equally between Christian and Jewish, received 411 gifts. F. 445 secular social service organizations, about 40% youth-related, received 759 gifts. G. 153 hospitals received 261 gifts. H. Health-related organizations, American Heart Association, American Cancer Society, etc., received 320 gifts. 3 things about this list seem particularly interesting to me. First, to some degree, it indicates what people choose to give money to when they are acting of their own accord, free from pressure from solicitors or emotional appeals from charities. Second, the contributions programs of publicly held companies almost never allows gifts to churches and synagogues, yet clearly, these institutions are what many shareholders would like to support. Third, the gifts made by our shareholders display conflicting philosophies. 130 gifts were directed to organizations that believe in making abortions readily available for women, and 30 gifts were directed to organizations and other churches that discourage or are opposed to abortion. Last year, I told you that I was thinking of raising the amount that Berkshire shareholders can give under our designated contributions program, and we asked for your comments. We received a few well-written letters opposing the entire idea, on the grounds that it was our job to run the business and not our job to force shareholders into making charitable gifts. Most of the shareholders responding, however, noted the tax efficiency of the plan and urged us to increase the designated amount. Several shareholders who have given stock to their children or grandchildren told me that they consider the program a particularly good way to get youngsters thinking at an early age about the subject of giving. These people, in other words, perceive the program to be an educational as well as philanthropic tool. The bottom line is that we did raise the amount in 1993 from $8 per share to $10. We reluctantly terminated the shareholder-designated contribution program in 2003 because of controversy over the abortion issue. Over the years, numerous organizations on both sides of this issue have been designated by our shareholders to receive contributions. As a result, we regularly received some objections to the gifts designated for pro-choice operations. A few of these came from people in organizations that proceeded to boycott products of our subsidiaries. In 2003, many independent associates of the Pampered Chef began to feel the boycotts. This development meant that people who trusted us, but who were neither employees of ours nor had a voice in Berkshire decision-making, suffered serious losses of income. For our shareholders, there was some modest tax efficiency in Berkshire doing the giving rather than their making the gifts directly. Additionally, the program was consistent with our partnership approach. But these advantages paled when they were measured against damage done loyal associates who had with great personal effort built businesses of their own. Indeed, Charlie and I see nothing charitable in harming decent, hard-working people just so we and other shareholders can gain some minor tax efficiencies. Berkshire now makes no contributions at the parent company level. Our various subsidiaries follow philanthropic policies consistent with their practices prior to their acquisitions by Berkshire, except that any personal contributions that former owners had earlier made from their corporate pocketbook are now funded by them personally.